Hey, good morning, everybody. Buenos dias, Southern Snowman. How come it's warm till you got here? I must have brought some of that stupid Washington weather with me. We drove back up from Florida over the weekend, and it was funny. It was there was snow on the ground by the house. Not a lot, but definitely a little. Guys, I'm going to mute 1 second and unwrap my cord. Hold on, just 1 second. Back. Hopefully you can hear me okay. My headset cord looked like a slinky. It was all wrapped up. It is a little tight. Man, I got the loosest cord ever. Guys, this is an educational room. Um, and I'll tell you what, treat it as such. There's 7 of you here. All of you are old school. You guys know the disclaimer, so that's for YouTube. This is an educational room. I don't call trades. I do want to talk about news, though. Um, all of you know to look out for red impact news, right? High impact news, those red boxes. So I'm going to point something out. Medium impact news can affect the market. If you were watching, I'm assuming the S&P moved the way the NASDAQ did. There were these crazy bursts with absolutely no scheduled news. Chances are somebody from these meetings stepped in front of a microphone. And guys, the risk, if you will, has gone up today. Today is a medium impact news day all day long. What does that mean? Typically, that means that the market may change directions, that the market could spike, that the market could become erratic. So as you go forward today, keep that in mind. It has been my experience, and although my experience is limited compared to some of yours, that on days where the entire day is considered medium impact, having your management hat on pays dividends. Tomorrow they're saying it's red, that it's high impact all day long. Now, I know Ron was here for it, probably remembers it. We had OPEC meetings that were high impact all day, and I would say 90% of the class blew out their accounts and lost huge. So you know that it's there, and now you have to make the choice. The choice is up to you. I don't tell you to make good decisions. I just let you know when things may go a little silly, right? They don't tell us when that guy will step in front of the mic. You remember OPEC. It just happens. And then suddenly somebody goes ape shit and the market becomes difficult. So you guys have seen it, you know, and now we're going to read indicators. Um, I'm going to try to, and Paul, I had an epiphany on your pullback, and I've forgotten it since, so hopefully it comes back to me. We're going to focus on reading the charts, guys. And we're really going to talk about advantages. Advantages set us up. Advantages ultimately become trades. And trading is only about 10% of the typical day. 90% of the day is doing nothing. And there's a lot of nothing to do. You will have, for every, I think this may be a short, you'll have to compare that to your rules and see if it's a rules-based short. And if you sit on that and you really focus on that in the beginning, is it a trade? Well, everything is a trade, right? But is it a rules-based trade? Is it a trade that I can prove wins more than it loses? All right, Paul, I remembered my epiphany, and I'm writing it down on a piece of paper, and we'll discuss it on entry. Almost had a senior moment. The whole goal is to learn to read your charts, guys, to read your indicators, to understand what they're telling you. And when you do that, when you focus on that instead of the money, and I'm going to say this real loud, guys, I've had this conversation via email about 75 times in the last 2 weeks. When you are chasing money, you tend to abandon rules. When you lean on your rules, when you force your rules to be met, what happens is the money is a byproduct. It's a product of having an edge when you enter the market. So when you start focusing on advantages, you begin to grasp these concepts and understanding where the market is likely to continue. Here to beat Mario, then rob him. I love it. You understand where the market is likely to go. That's great for targets. And you understand where the market is likely to stop. And I had a video come up on my Instagram this morning from Eddie Z Computers talking to John Novak. And John Novak expressing the importance of understanding where a market is likely to stop, where it's not lucrative to take that next trade because the area you're trading into could create a reversal. These concepts, guys, likely to continue becomes ways to enter. Likely to go is where how you're going to manage, how you're going to set up profit targets. And then likely to stop is really going to keep you in that 90% if you're paying attention to what your indicators are telling you. This is a picture that I came up with. And guys, I do these things in my head and I try to translate them out, but I like this one because the market goes up and down. This I know for sure. I don't deal in a lot of absolutes, but this is an absolute. The market goes up and down. So I can buy the market in an uptrend if I'm a trend trader. I can sell it in a downtrend, and if it's in a transition where I'm having difficulty discerning the trend, I can wait for the trend to be established. When a trend is established, whether it be up or down, there's almost always a small fight against that trend. The trend trade methodology has you pinpointing where that fight is most likely to be lost, guys. This is your likely to continue spot. This is where the underlying trend is most likely to bounce and then just get back to business of being in that trend. That's what the trend trade is. If you can wait for that fight to happen and you take that trade that can be proven to win more than it loses, and that's the easy trade. That's the trade we're going to talk about first, whether it be NinjaTrader or whether it be TradingView. So what we're doing right now, if you're a brand new user or if you're an older user struggling to find success, what you're doing right now is you're learning to wait for that fight with a trend trade, because on both platforms, the rules can be proven, tested by you to typically win in a 70 to 80% range. Now, of course, the other side of that coin that nobody wants to talk about is that anything that wins 70 to 80% is also going to lose 20 to 30%. So in order to stay consistent with the potential and the results, the expectations, you have to be consistent with the rules. So what we're focused on is not the money that the rules produce, but rather the consistency of the execution so that we can create that expectation, let probabilities take over. So TradingView and NinjaTrader, both are discussed in this room, and they are very different. Some would say apples to oranges. But they're also very, very similar. Maybe it's oranges to grapefruit. But we're going to learn the rules for a high probability trend trade on both platforms. I'm going to break them down individually. We're going to talk about them. We're going to describe them. We're going to show them. And you'll be able to use them in the plan that I give you guys. You're allowed to simulate. There is no pressure to trade a live market. Those of you that feel the pressure and say, well, I'll just go to micros and I won't feel that pressure, you're kidding yourself a little bit, guys. You're going to feel every bit of pressure over dollar as you do $100, as you do $10, because you're going to be focused on the desire to win and not the execution. Because if you really believed the method, you would know that whether it is crude or S&P, whether it is NASDAQ, whether it is a micro, whether it is a regular contract, it's just a pattern. It's a pattern that you'll be able to prove wins more than it loses, guys. And practice that pattern. Practice your entries. Practice your chart reads. Practice your recognition of rules. And then the first step in becoming a confident trader, ASAP, is post your trades in the room, whether it's live or practice. Drop something in the room and say, hey, Mark, check it out. This is what I saw. I saw that there was a weak top and that the triggers had rolled down and separated, but this was 50-50 at the absolute best. So as the momentum was pushing, I let it break below trouble, and when it snapped back and tested, I entered on the way down with all of that momentum on both charts. And then as it came down, it turned into another trend trade, so I didn't worry. And then I got paid and out with the trailing stop. And Pete, this is awesome. It's a good looking trade. But what Pete did is he said, this is what I saw on my lead chart. This is how I reacted on my small chart. Mark, do you see anything that might have made life easier on me? Do you see anything that might have reduced risk? Do you see anything that could have increased profit potential? And I could say, Pete, you could have taken the snapback to the one-to-ones instead of waiting for confirmation. But when things are zipping, sometimes you don't get that. Sometimes you're a couple ticks late. Pete, great looking trade, man. But that's what you get every time you post in the room. And the language that you put on the charts is telling me how you're reading your indicators. And the words that you use tell me what you're thinking, guys. And very often it's one or two words that open the door for a fantastic lesson. And when you talk about what you see, if there's a mistake, we can fix it, guys, and we can come up with a plan to fix it. So post in the room. Don't be afraid of posting too much. You can't. Don't be afraid of asking the same question too many times. You can't. Until you have your answer clear, I need you to keep asking that question because it means that I'm missing something that you need to hear. The second thing is simplify. Simplifying your plan as a brand new user. Keeping it very, very basic, very, very focused is definitely advantageous. For the new users, TradingView and NinjaTrader, I hand out the KISS plan. Now the KISS plan is a stepping stone. It's a foundation. It's the beginning of your journey with the software. Or perhaps you're not finding the success that you wish you were finding. This is a great way to refocus, gather the troops, and get into a groove of waiting for the best of the best, guys. This plan is designed to teach you to read your indicators. It keeps you focused on the advantages that your indicators produce. The trades within the plan are designed to optimize your chances of success, which means, in no uncertain terms, when you follow these checklists for entry, John Novak and I have done such extensive work, and we've taken so much feedback from clients, and we've done so much live testing of it, that when you follow these rules, you can say to yourself, man, I'm taking a trade that typically wins more than it loses. I'm just going to focus on the execution of one trade. I'm going to follow one checklist. I'm going to take one best of the best. And then when I learn to be consistent, perhaps I'll look for more. Excuse me, I'm so sorry. That simplicity, that pattern that we're teaching with the high probability trend trade, you've got to learn that pattern. You've got to know what it looks like to have your rules met. You've got to know what it looks like when those advantages come together to create a trade. And that's kind of the second thing, guys. Use the spreadsheet that I gave you, and I just dropped it in the room. This is for NinjaTrader. I'm taking the rules for the high probability trend trade, and I've done a lot of work for you, right? I've given you fish and showing you what it looks like to have each rule met. Your job is to do the work, to add more fish to the pot, if you will, to take pictures, to study, to recognize these rules individually, so ultimately you can piece them together to create a trade. There's client trades showing the pattern repeatedly, ideas on management, patterns, entry sequences. If you're working through those entries, there's a place for you to put your pictures. You should fill this thing up. The more pictures you take, the faster you will read your charts, the more opportunities you will see. And then finally, both of the spreadsheets that I gave you, regardless of the platform, have a tracking sheet. The tracking sheet does a couple things for you. And first, and I'm going to say this, the CME will tell you when you go to the Chicago Mercantile Exchange website and you say, what do I need to be a day trader? They will tell you. You need a log, you need a journal, you need to catalog the trades that you take and talk about them and analyze them. And I've given you a platform for that here. And then when you post in the room, you get that private session. And after you get that private session, there will be feedback associated. Hey, what's up, motherfucker? There will be feedback associated. I left it on your desk, man. I left it on your desk. And the feedback is where the good stuff comes from, guys, because you'll have your annotations on the chart. This is what I see. This is what I did. But you're also going to get the feedback from me. And maybe you missed something. And maybe you didn't catch it. Maybe you traded into trouble and you didn't see it. And what happens is when you look at that feedback, if you spend 2 or 3 minutes every morning looking at what you did yesterday, asking yourself what worked, what didn't work, what felt easy, what made me nervous. Guys, what you're doing is you're preparing for the day. You're staying focused on the good stuff. And you're saying to yourself, man, this is a pattern that seems to cost me more than it provides. And that's your thing. And we all have a thing in the beginning. And I'm going to share a picture that I took this morning of what my thing was for quite a bit. I trade the NASDAQ. I very often trade on NinjaTrader. And I use reversal bars for entry. And this right here, if my reversal bar, even on a 50-50 trade that looks pretty good, finishes into trouble, I lose that trade more than I win. And guys, I didn't catch that in the beginning. I just thought I was taking great trades that didn't work. And this is a pattern that emerged that became part of my plan. Because what I would do every morning, the same way I ask you guys to do it, is I would go back and I would stare at my charts. And I would say, okay, what's the common thread in the loser? What's the thing that seems to be messing me up more than it helps? That was my thing. That was my most recent thing. And since it's elimination, I can't tell you how many losers I've avoided. So fill out your spreadsheet, guys. Take 1,000,000 pictures. The people that take the most pictures, the people that post the most, get to where they want to be. I finally made it over 20,000. After 20,000 pictures, guys, there's a clarity that just falls right out of the sky. So we're going to learn the rules. We're going to do NinjaTrader and then TradingView. You guys simulate, practice, post in the room. Motherfucker, you get it all under control, man. You no more angry blowouts. Kicking butt and taking names, I hope, man. Simplify, guys. Keep it simple. Trading doesn't have to be difficult. We tend to make it difficult. And learn those looks. So on NinjaTrader, it's 3 rules, guys. That's it. 3 rules. When a rule is true, it creates an advantage. When the advantages come together, that's your trade. Process creating results. These 3 rules happen on 2 charts. There's a big chart and there's a small chart. I thought I was supposed to have new people in the room today. That's why I'm going so 101-y, but that's okay. The reinforcement never hurts. Guys, large chart is slow. It's broad stroke of a brush. Gives you everything you need before you ever look for an entry. Focusing on your small chart before large chart advantages are in play is a recipe for disaster. Your large chart using the most bar, the first bar, will define direction, momentum, and areas. Your first 2 rules, your first 2 advantages come from a large chart. The small chart shows you that fight that we talked about. When a trend is established, when rules are met, there's very often a fight. On the large chart, it just looks like a tail. Can't predict where that tail is gonna form. But on a small chart, we're going to use the entry methodology to pinpoint where that little fight is most likely to be lost, guys. This becomes your entry for the highest probability trend trade. By using a smaller, faster chart, you will reduce risk, you will maximize your profit potential. Your large chart is a big crowd. These are the institutions. These are the people that react to news. These are the people that react to Fibonacci. These are the people that create trends, that establish momentum. They typically win. Just going to let you know that. Small chart creates the fight. These are our fighters. We love these guys because they give us the best possible entry. Know who you're trading with or who you're trading against, guys. And now let's go over indicators. Areas. Horizontal lines on a chart. They bounce. That's the easiest way to put it. Every line on a chart has the potential to create a bounce. And when you accept that, it changes the way you look at your charts. Triggers do everything. There are small triggers and large triggers. Small triggers are a fast-moving average. Large triggers are a slow-moving average. And guys, that idea that these are averages comes into play. Because on your large triggers, when price pulls away from large triggers, it tends to pull back to large triggers. And when price pulls away from large triggers, it tends to pull back to large triggers. We're going to use that logic to use these large triggers for our amazing entries. We're going to use the small and large together to define the advantage of momentum. And we're going to do a comparison of these trigger lines, all four of them, too small, too large, up against these areas to know if those areas have a high potential of stopping the market or creating an untradeable bounce. We're going to learn to read triggers using only 3 rules, guys. So now I'm going to break them down individually. If you have questions, interrupt. Large chart must have strong triggers. Strong triggers is one look, guys. When the background's green, the trend is up. When it's red, the trend is down. You can fight that all day if you want, but the easiest thing to do is simply go with it. Strong triggers in an uptrend. On the most current bar, so I'm going to do this. In an uptrend, it's going to look just like that. Small triggers have broken above the large triggers. Large triggers are wide, angled in the direction of the trend, and there is space between the two. That's what it's going to look like on your most current bar. In an uptrend with strong triggers, the odds are favorable for the market to continue up. In a downtrend, most current bar, small triggers will break below the large triggers, space between. Guys, that space lets me know that the odds are favorable for the market to continue down. Strong triggers is one look. And if that separation goes away, if you're looking at the most current bar and there is no space between the small and large, you have what we call weak triggers. And when I have weak triggers, anything can happen up or down. This is where key Fibonacci areas are more likely to hold. This is where even reversals from the middle of nowhere can occur. So if we go to the most current bar on crude oil, give me a Y if you see smalls above the large, space between. Guys, that is your strong look in the now, right now. It's always this look. And if there is no separation, there is no strength. And if there is no separation, that's where things tend to turn. That's where areas tend to hold. Strong triggers, just one look, guys. It either is or it is not. Don't overcomplicate it. Termination conditions, false. Areas that could stop the market, false, because we want room to profit targets. This is the most broken rule among you guys because this is the one that's going to keep you in that 90%. A termination condition can be a horizontal line on a large chart because horizontal lines can create bounces. When none are present, we're going to call it a clear path. And we're going to couple that clear path with momentum before we ever think about an entry. So when I say the large crowd, the people who make decisions, the 1%ers, the institutions, the big fish in the pond, when they reach a line, they tend to make decisions. So the first step in your termination condition recipe is that price reaches a line, area of resistance in an uptrend, area of support in a downtrend. Any horizontal line on a large chart. When price reaches that line, we're finished with price. We no longer worry about it. We let the triggers tell us what we need to know about that area. If all of your triggers, all 4 lines, remain below resistance, resistance is a termination condition. It may reverse the market. If all 4 lines stay above support, support's a termination condition. It may reverse the market. It might just create a big ugly bounce and then continue in the direction of the trade. It might even break. You'll never really know what the reaction is going to be, so keep it simple. If price reaches an area, just ask yourself, where are my triggers? And if they don't get above resistance or below support, it's cool. Sit on your hands. Wait for the reaction. So here's what it looks like when they break. We saw what it looks like when it reverses. Here comes your break. First, price reaches support. All the triggers, 4 trigger lines are above support. This is an area that may stop the market, that may create an untradeable bounce. This is an area that could reverse the market completely. Since I don't have a crystal ball, my highest chance of success comes from waiting to see what the reaction is. Absolutely no trades into the area. If my small triggers, not price bars, but if my small triggers break below that area of support with momentum, that area now has the potential to break. We call this a 50-50 look. 50% of the triggers are through, 50% are not. This potential is tradable. This potential is the second trade on the KISS plan that I gave you, but it is just potential. So these trades have to be managed assertively. I give you in the KISS plan a way to optimize your chances of success with these 50-50 trades. The rules and the checklist for entry are very specific to keep you focused on having the highest chance of success. And support is considered broken when all 4 triggers, both small and both large, get below the area of support. Once all 4 triggers get below, support actually behaves as resistance. Your path is clear, and your path is going to remain clear until you hit the next line. And when you hit the next line, you're obligated to go back to number 1. So it's just counting triggers. This is your cheat sheet. And I am going to drop this PowerPoint in the room, guys. I think it's important that you take it, that you go back to it, that you study it. If price reaches a line and 0 triggers make it through that line is a termination condition. That termination condition may stop the market, create a bounce, reverse it completely. If 2 trigger lines get through it, that area does have the potential to break, but just between us, don't tell my brother I said this. It's a pretty shitty look. This trade will lose more than it wins. 2 triggers through is not your best look to trade that probability. Your highest chance comes when 3 of the 4 trigger lines break through that area. Guys, when those moving averages start getting north of trouble, they're already on their way. We just need to make sure that things go with it. This is going to be your take and manage, right? Be on the lookout. Assertive management. And then when all 4 trigger lines get through, man, it is all bets are off. With that momentum, with that clear path, I'm going to go look for an entry. So let's take a look. You guys want to back it up a little bit? I love this. Price reaches yellow 1-to-1s. Huge ugly bounce. Right back to support. Triggers don't break. Another bounce up to 1-to-1s. Triggers don't break. Back to support. Triggers don't break, don't break, don't break, don't break. Holy crud. Rule number 2, keeping you out of consolidation that is notorious for eating accounts, guys. All you have to do is learn to trust it. Finally, the termination condition wins. The market pushes down. They're screaming. They break an area. Oh my goodness. And it reaches Fibonacci support damn near to the tick with weak triggers, and you get a reversal up. And strong triggers breaks that area, and it hits a divergence high with weak triggers, and you get a nasty reversal down straight to Fibonacci support. Take care, Andy. And then it goes up, and then it goes down, and 2 triggers through. And now we are currently with momentum, looking at the potential to break resistance. Guys, rule number 2 will become a colossal pain in your ass as a brand new user, because there will be times when you just can't get that clear path, when even though you've been patient, they're just not giving it up. And guys, this is 90% of your day in futures markets that typically exchange $220 billion hourly. Most of us in the room trade the S&P. The S&P exchanges about $174 million a day. It takes $400 a day consistently to put yourself in a 6-figure income on your trading. 252 trading days, $400 a day. It's like $106,000. You don't need every move. You don't have to be the first person in or the last one out. You don't have to hit home runs to be a 500 batting average. Guys, focus on your process. Focus on the easy trades. Focus on the trades that have, here we go. I love this picture. I've gotten so much mileage out of this picture. When you have momentum and there's nothing in the way, when you're trading away from Fibonacci, when you're trading to Fibonacci, guys, you're going to see that little fight. Those tails on the large chart are the pullbacks on the small chart. You're going to pinpoint where those tails are most likely to form. This is the most stress-free trading you could ever do. And that's what we're focused on right now, is the absolute stress-freest trading known to man, or at least Nexgen clients. So large chart leads the way, begins with the advantage of momentum through strong triggers. It's imperative that you have this because you do want a market that's difficult to stop. And then you're going to assure yourself a clear path by not trading into an area that has been defined as a termination condition. You want to make sure you have room back to profit targets. And when you have momentum and path, guys, this is where the magic of the methodology comes in. You're going to call your shots using rule number 3 for entry. And you're going to call it, I want you to learn this phrase. I want you to print this out. I want you to put it on your desktop. I want you to commit it to everything you do when you enter a trend trade, because what will happen is you'll never wonder where the market is most likely to bounce in your trade, guys. You're going to use a limit order. That's how exact it is. And you're going to buy or sell a pullback, that little fight, right? When everything says up, your pullback is that small push down. And when everything says down, your pullback is that small push up. So you're going to use a limit order to buy or sell that pullback, but you're going to do it at an area because areas are bouncy. I'm going to get that put on a t-shirt. Areas are bouncy. Fibonacci support or resistance, yellow 1-to-1s, a mid-band. All of these are equal. One is not more bouncy than the other, but those areas must be inside of triggers because triggers are going to show you exactly where the market is most likely to retrace. It's that moving average concept. Price returns, be careful, that's true. Price returns to large triggers. So this isn't in my PowerPoint, but I'm going to show you guys this picture real quick. There's a concept. I coined this phrase probably 6 years ago. Favorable large triggers. Your large triggers on your entry chart, and there's large and synthetic. There's a mathematical phenomenon. We think it was introduced by aliens in the 40s. Price returns to the moving average, regression of the mean. So these moving averages, big slow moving averages, show you exactly where that retracement is most likely to go. The tighter those triggers are, one on top of each other, the less amount of risk you're going to have, the higher the accuracy you're going to have, because it's a very concise spot. So you could say, as a brand new user, that I will use a limit order to buy or sell a pullback at an area inside of favorable large triggers, should you choose to go that direction. But it's just a pattern. And I think this is the part that I really want to stress the most. It's a pattern. Entry is a pattern. When everything says up on the large chart, the reversal bar signals the beginning of your pattern. That's the beginning of the fight. The reversal bar is not your entry. You're still way too far away from areas inside of triggers. So when the reversal bar prints, and with just a little bit of study, long before it prints, you'll be looking for those large triggers, large and synthetic, and you're going to say to yourself out loud, scaring the goldfish, price is most likely to retrace somewhere from the top line of those triggers to the bottom line of those triggers. I don't have any freaking idea where, but that's my range. That's where the price is most likely to return. And you're going to remind yourself that hitting triggers is not your entry because triggers aren't bouncy, areas are. So you're going to look for Fibonacci support, green midband or yellow 1-to-1s in a long trade. Inside of triggers, inside, all caps, so important. Because these are the areas where the market is most likely to bounce and continue in the direction of your large chart advantages. Buying a market on the way down can be scary, but guys, your entry is the highest point of support inside of those triggers, closest to the reversal bar, because your large chart is gangbusters north with nothing in the way to stop it. We're not going to get caught up over a couple pennies trying to save a few dollars. This is the fight, and now we're looking for continuation. Looks the same every time. And here is the cool thing about what we do. If you learn the whys of entry, why do I look to the trigger lines? Because until I get to the other side of those trigger lines, the advantage of rule number 3 is still in play. My panic button doesn't get hit. So if I enter at the highest point and the market goes lower, I don't worry about it. I still have an edge. And as it approaches that next area, I think maybe this is the area that could bounce and stop that market. And if it goes a little bit beyond, but it stays in the retracement zone, I refuse to panic. As long as you are in the retracement zone, the advantage is still present, guys. Once you get below these triggers, 4 or 5 ticks below these triggers, you are where the market should not go. You are beyond the outreach of the advantage of rule number 3. Your initial stops in a high probability trend trade will be placed 4 to 5 ticks beyond the triggers, on the wrong side of the triggers. Because once you get below those triggers, my friends, you don't know if, when, or where that market is going to continue up. You're going to wish that that fib would hold the market and send it rocketing, but the reality is the edge is gone. The advantage is gone. The rules are no longer met, and you're clinging to hope. So by defining where the market is most likely to continue in an area inside of triggers, you are defining where the market should not go. All lines beyond the triggers are meant to be ignored because I don't know if, when, or where that market is going to continue down. Why would I enter the market where the market should not go? Let the words resonate. So here's your pattern. We're going to piece it together. If you remember, we said a trade, the perfect trade, the ideal trade, the happy-go-lucky, I can't believe how fortunate I am to be in this trade is momentum, path, and entry. Momentum, path, and entry every time. So we'll just cover that up. So first it's momentum, separation between the small and large. Then it's at least the potential to break with 2 triggers through. And then it's a pullback to an area inside of triggers. This is your recipe. This is your pattern. If you take a trend trade, I'm going to go to the tracking sheet to the client trades. If you take a trend trade, it should have momentum, path, and a pullback to an area inside of triggers. If you take a trend trade, you should have momentum, at least the potential to break, and a pullback to an area right there at the triggers. And if you take a trend trade, you should have momentum, the potential to break, and a pullback to an area right inside of triggers. Guys, it is one pattern that is repeatable. It's one pattern that is testable. You've got about 400 examples on that spreadsheet. It was the same November 6, 2025 as it was in 2021, as it was in 2022. Guys, that is your highest probability trend trade ever on NinjaTrader. I'm going to show you how to study it. Dun, dun, dun. Let's see if we can find one of those magical tails that we talked about. Probably a better chance on the S&P. If I have momentum, man, the market's been crazy today. Might have been something to do with that news, right? If I have momentum and the potential to break, and man, you had to be patient today. Have we seen a, there we go, we'll take this one. At least the potential, all the momentum, room to trouble. I'm going to circle that tail. And on that circled tail, I'm going to scroll back on my small chart until I found it. Wow, 90% of my day is doing nothing. That tail is a pullback to an area inside of triggers, and then it continues down with the momentum. Hey guys, this is your pattern. It's this pullback that reduces risk. It's that pullback that maximizes profit potential. It's those triggers that define your entry, understanding exactly where your stops have to go. So I encourage you guys, learn your pattern. And once you learn your pattern, life gets pretty easy. And now we're going to go to Trading View. Are there any questions? We good? Everybody in here has been in this room forever. So I don't know where my demo went. Now Trading View. Trading View is not NinjaTrader. It's similar. Crazy moves right now. Trina, did you check your news today? Did you see that it's medium impact all day long? Makes it hard to trade. Trading View is similar but different. Trading View uses 3 rules to define the perfect trend trade. Why is it the perfect trend trade? Because you can prove this trade can win more than it loses. It's 2 charts. It's a big chart and a little chart. This should sound familiar. Your large chart is a 15-minute chart. It's a very slow chart. A lot can happen in 15 minutes. It's not uncommon on the NASDAQ to see a 15-minute bar span 50 or 60 points. It will define direction, momentum, key targets, and terminations. Your 1-minute chart shows the fight, defines the immediate strength and entry points, guys. On your large chart, you'll only have small triggers. You won't have background color. You won't have large triggers. You have small triggers. Cyan is up, white is down. Your small chart will have both small and large. And this is very similar to NinjaTrader. When the smalls are above the large, when they're spaced, this is strong triggers up. When the smalls are below the large, they're spaced, that's strong triggers down. You're going to use that momentum for a little bit of patience. You're going to use that momentum to take the second trade on the plan, the momentum trade. But it's the small triggers on the small chart that you're going to get in the habit of never fighting. And that's how your great entries are going to come to be. Both charts have areas. Areas are bouncy. That's really the key. Areas are bouncy. They can create bounces. I don't care what your opinion is. If you hit a 1-to-1, it can create a bounce. If you hit a divergence high or low, it can create a bounce. If you hit an outer band, if you hit a mid band, it can create a bounce. Just believe it. Large and small chart have both. So we're going to take a trend trade. We're going to teach it. And then Paul, my epiphany's coming into full play today. So first, to take a trend trade, you have to define trend. I feel silly saying that, but you'd be surprised how many trend trades I see throughout the course of a month that actually don't fit the trend. Rule number 1 says don't trade into stuff. 15-minute not trading directly into areas. Rule number 2 says that your 1 minute's not trading into areas. Don't trade into areas. Don't trade into lines. Lines are bouncy. Rule number 3 says that you're going to buy or sell a pullback at an area, whether it's a mid-band or a zone or a 1-to-1, but you're going to wait for a close on the weak side of the triggers. You're going to train yourself to not fight the small triggers, and I'm going to show you the pattern, but we're going to start with trend. Trend is either up or down. There's never been a left or right trend. So if my small triggers are up, I'm only looking for rules to be met for long trades. Path of least resistance, the trend is your friend. If my triggers are down, I'm only looking for rules to be met for trend trade short. That's my safeguard for me to keep me in line with what the large crowd wants. Now on the big chart, if I'm going to enter a trend trade, I must have room to make money, which means that wherever the market is, there's got to be room to get to trouble. If there's not, if I try to start a trend trade right there directly into trouble, I'm more likely to lose than win. If I start a trend trade from down here with room to trouble, I've at least got room to make money. Your small chart, when I enter the market, I'm not allowed to enter directly into an area. I have to have room to make money. Everybody has a different idea. Some of you love $30 or $40. I can't move that fast. Some of you want to make $100 before you hit something solid. Some of you want 200. You're going to have to figure out what works best for you. But don't trade directly into areas. Now, Paul, here comes my epiphany. This is what a trend trade entry looks like for a long trade. Now, Paul, we're going to read the top phrase. Small triggers roll down against your trade. That's the first step in the trend trade entry pattern. And Paul, I think this is the part that's going to keep you patient. Small triggers roll down. Once they roll down, I look lower. So over here, I'm not looking for the trend trade. Small triggers never rolled against me. It's got to be a different sort of trade if they don't roll. So once the small triggers turn down, when my large chart says up, I start looking for lower areas. When I get to said lower area, I don't just jump in. Have this conversation with John 7 or 8 times a week. Buying the areas on TradingView doesn't work as often as you like because these small triggers are strong. It's a 1-minute chart. And when you get in left of those small triggers, whether it's up or down, it has the potential to push lower. So your entry is an up bar that finishes both corners above those small triggers. It puts you on the winning side of those triggers. This is where the reversal to get back in the good graces of the large chart typically happen. So when the large chart says up, when there's nothing in the way, I can go to my small chart because the rules are met. On the small chart, when the small triggers roll against me, Paul, this is my epiphany. When the small triggers roll down and these triggers are up, I look lower. I look for a lower spot. When I get to that spot, it's the up bar that closes on the correct side of the triggers, the weak side of the triggers. That's the entry for a trend trade long. Because the small triggers roll against me, I wait for the pullback to the area. Down bar that closes below the triggers is where the market is most likely to reverse and continue with the large chart advantages. So I think if your triggers never roll against you, it's difficult to call it a trend trade. You've got to throw it into a different trade category. Doesn't mean that it's not the right trade, but it's a little different look. We'll look for examples, Paul. Finally, I want to talk about the relationship of price to the small triggers on the large chart. We're going to use this to define momentum, guys, and this is the first step in management. Before you ever go look for an entry, you'll know how you're going to manage that trade. And it's pretty simple. If the small triggers are up, where's the most current price in regards to those triggers? There's only 3 options. It's either left, right, or center, inside. If you're left of the triggers, this is the strong side of the triggers. This is where 1-minute areas are most likely to break. This is where bigger moves typically happen. If you are right of the triggers, this is the weak side of the triggers. This is where we want to be for entry because from the weak side of the triggers, there's less push. From the weak side of the triggers, that's where reversals come from. Now, because the 1-minute chart or the 15-minute chart is so slow, you could go from weak to transition to strong in 1 bar. So we're still looking for long trades. We just got our management hat on because 1-minute areas are most likely to be problematic. And if you're in transition, you're neither strong nor weak, which means you're probably getting out of trouble, but maybe holding a contract to see what happens. Kind of that split contract thought process. So, guys, that is 2 platforms, 3 rules, 2 charts, odds favorable momentum in play, only the potential to break, but you can see areas inside of triggers if that look fits your plan. The NASDAQ, triggers are up. There really isn't much room to a VWAP. Well, actually, those are pretty big because of the volatility. Here's your pullback because the small triggers rolled. I would need an area and a close above to take the trade. And I think that's what it is, Paul, is for a true trend trade, you're going to see this look right here. If you don't see that trigger look, that's where the momentum trade comes in. That's where the second trade on the plan comes in. But the momentum trade, that's the wrong plan. The momentum trade relies on strong triggers on the 1 minute. And if you just don't have that strong trigger look, then you're just not getting your best of the best. You're not getting your highest chance of success. And it's not saying that it's not a trade. I'm saying that it's a trade that falls somewhere between trend and momentum. And it doesn't have the push of a momentum trade, and it doesn't have the fight of a trend trade. And maybe that just means manage a little more gracefully. I'm not sure. Because it's not a trend trade or a momentum trade, I don't take that trade. But if you do, you're going to want to come up with a management plan for it. That was my epiphany, the small triggers rolling. Good stuff. Guys, that's the first hour. So the rest of the day is going to be this. The rest of the day is going to be clicking on the charts that you guys post. Let me see where we're at here. Clicking on the presented charts and talking about them, talking about momentum, talking about path, talking about entry, talking about risk, talking about profit taking. Not playing the trade police, but rather making sure that as you read your indicators, you're reading them correctly. So when I go and I go back and look at your charts, guys, if you really want feedback, and if you don't really want feedback, just post it with no annotation. We'll high five your winner and send you on your way. But if you really want feedback, right? If you want to make sure that you're reading your indicators correctly, if you're looking to make sure that you're embracing the best opportunities, on NinjaTrader, do me a favor. Address each of the 3 rules. Address momentum, path, and entry. So draw an arrow to your trigger lines. Where you took the trade, not 7 minutes earlier, you know who you are. Where you took the trade, the bar that you took the trade on, point to the trigger lines. Describe why they're strong or why they're weak, because what you're doing is you're creating a neurological connection between what your eyes see and what your brain is being told to think. And the more times you do this, the easier it becomes to read your charts, the faster you read your charts. Do the same thing with terminations. Count those triggers. Was it 2? Was it 3? Was it 4? Was it the potential? Was it a clear path? Tell me what you think. Not because it affects whether or not you take a trade, you're the only one that affects that, but when you know the difference between potential and a clear path, you know how you need to manage that trade, how assertively you need to manage. And then talk about your pullback to an area inside of triggers. And if you chose not to take it at the area, maybe you waited for confirmation, you could even throw the Y's in there and we'll talk about it. Hey, that kind of makes sense because it was only the potential. You wait for a little confirmation and talk about your management. There's always a way to do it better, guys. I learn something every day. If you're on TradingView, talk about the direction of your small triggers and say why it's important. My small triggers are down. My rules say only shorts. Create that habit of believing your rules are the gospel truth. Price is on the strong side. This look may produce bigger moves, but be aware of 1 minute areas. Think one runner. Room to targets. I have room to make money. Small triggers rolled up, so I need a pullback to an area, then a down bar that closes below small triggers with room to trouble. You have literally written the recipe for the perfect entry. If you go through this every time, you're telling me how you're reading your indicators, you're telling me what you see, what it means to you, and what I can do. I'm going to double check that, Victor. Well, orange isn't red, right? Orange isn't red. But the prop firm rules say absolutely no trades during red flag news. So I'll get confirmation on that. I forgot what I was going to look at. You know what? I'll get confirmation on it right now. Dun, dun, dun. 1 second. There we go. I guess the real question, Victor, is if it's red all day and it can be batshit, apeshit crazy. Look what orange is doing. Do you want to risk your semi-live money because you don't want to not trade? That's one of the things that are hard. And I'm going to tell the story again. And Ron remembers the OPEC day. I remember talking to him about it. It was red news all day long because of OPEC meetings. And if there were 50 people in my class, 49 of them made the choice to trade and just decimated accounts. Took loser after loser after loser. Um, so it's up to you. But you guys see the S&P? It's not trending, guys. That is not a trendy market. And there's little opportunities probably, but I'm keeping my management hat on, guys. There's huge fights going on. Huge fights. Yep, we did. And I'll be sim all day tomorrow. I won't touch a live account tomorrow. I've been hurt before. I've learned my lesson, but you guys have to make your own decisions. Me too, neither. All right, guys, I'm going to go take 5 minutes. When I come back, we'll look at all the pictures that were posted. If the rules are met for high probability trend trades on either platform, we'll take them, we'll manage, we'll talk about them. Post them if you've got them. If you have questions, please post them in the room. One of the most frustrating things for me is when someone's been in my room for 30, 60, 90 days and they say, I thought. Oh, I thought that price breaking through meant that it wasn't a term. Oh, I thought that if the colors matched, that momentum was good. And guys, the biggest detriment to most traders' success is creating their own truth about what it means to have the rules met instead of embracing the actual truth. And guys, you get the actual truth here in this room. Exactly what it means. So I'll be back in 5. Post them if you got them. Thought so, but. Yeah, your butt. Don't show your butt. It rarely works out. let's get towards your pictures. And matter of fact, you're right, man. So I don't know if you check U.S. News every morning, but U.S. News has us in medium impact all day long. There's meetings going on. There's indecision. There's a bunch of yahoos that like to talk into microphones, scaring people. All right, close below the small triggers. Question is, would I have taken the entry if I'd seen the 15-minute chart? There was 10 ticks to the 1-to-1s. So plenty of room to the 1-to-1s, right? Not a lot of room on the 15 here. Starting thinking about OPEC run. I hear you. And I'm going to get clarification on tomorrow, but I told them we have to hold the line. So we'll see what happens. So no, what it is, motherfucker, and I do. I love saying your name. High impact news is a deal breaker. 100%. High impact news is she would elbow me in the ribs. Absolutely no trading during high impact. Medium impact can have the same result. Medium impact can create a little indecision. It's not always as bad. But today is medium impact news all day long, which means that every time one of these people go out to the press and says something that pisses off somebody with money, it's bad. Red folder days are best for you. Red folder days, if you're in the funding company, you're not allowed to trade. Because chances are you're just getting lucky. And that runs out eventually. So, good stuff. All right, Paul. No, motherfucker, I'm going to respectfully disagree with you. Respectfully disagree with you. Trend is down, Paul. Right? So there's your fight. There's your break. There's another bar that breaks. And then there's your fight all the way up to there. That's okay. We can do that. That's what grown-ups do. There is your close below from the area. So, Paul, that's definitely a break, a pullback, and a close below. And what do we notice about it? See those small triggers rolled up, Paul? Because when you get a big enough fight, they do that. So there's kind of what sparked my epiphany. Does that make sense? So while there wasn't room on the 15-minute, that's a pretty good looking pattern for entry. Good stuff. You made me a better teacher today. I appreciate that. And that's the same one, right? But there's no room on the 15. All right, Cav. Everything says down. The market is screaming. And Cav recognizes a really cool pattern. He knows it's a pullback to an area inside of triggers. And Cav says, do you see that second higher divergence? Very often, it tests the previous high. So he uses those 1-to-1s right at the previous high, those small swing 1-to-1s. This was a great chart read. And guys, this is one of those things that you get with some time in the saddle. Cav, great trade, great short, quick profits. And then after third divergence, it's okay for it to be party over. Nice trade. Pete, all the momentum from a termination, quick pullback to the area inside of triggers, awesome profits. That's your pattern. Pete, you know what my favorite part about this trade was? I don't know if you're listening. Is that you didn't jump in up here. That you recognized that there wasn't enough momentum to push a momentum trade, and you waited for the perfect trade. I love this. I love everything about this. Nicely done, Pete. All right, trend trade. Triggers up. Room to targets. Your analysis. I love this. My analysis. I believe my mistake on this trade was not setting the stop loss correctly to the lowest pivot. I see it right below the mid band and it got hit. I have set it where it belonged at the next area the lowest pivot was. It would have been a totally different trade. Don't let the numbers scare you. So guys, stop placement on a trend trade. Head coach. That's all right. You got us there. What you can't see on Victor's chart is that the fight came all the way down here. And then it started back up. So the stop placement rules say use the lowest pivot of your trend trade for entry. And honestly, Victor, that's huge. That is like by the time you get the close above, that's like 25 points, which is a lot. I understand why you use the pivot here, but you're right. And sometimes you just got to say, man, maybe it's not mine. And then, Victor, can we look at the other half? And this is something that you're getting to the point where you'll notice. The sellers fail, and they try to push up, and then the sellers fail again, right at the mid-band, and then there's your close above. So even though you got stopped out, isn't that still trend trade rules true? Isn't that still room to trouble? Isn't that still everything good? And I think that when we're newer, well, even if you took the first one makes sense. The idea of taking a trade twice is terrifying because the first one just lost. But when you start going through it, wait a minute, it's still the same trade. It's still the same great entry. It's still above support. It still has all the advantages. They just did a little stop run. And you realize that that's all this is. See how it's a pivot stop out right here? What did they do? They took out that low right there. Boom. By a tick or two. And then it was upsville. When you guys lose a trend trade, even if you don't take the re-entry, go back and see if there was a re-entry. A lot of times there is. As long as the rules are all still true, you will have to take trades twice from now and then. The key is to not take them 17 times because then they're just not working. All right, this looks like a Pete chart, I believe. No, this might be a Cav chart. Good bottom. Triggers up. Let me see where you get in. You get in all the way up here. So all the momentum and nothing in the way. Those first two advantages. Get in above trouble. Get out before trouble. Great trade. Momentum and path. Find a way. Once you understand momentum and path, you'll find a way. It's amazing how often you guys do it. Trend trade. Triggers up. In transition, assertively and set stop loss correctly. So pull back to the mid-band. There's your close above, right into trouble. You chose not to take it. And then it breaks and it pulls back to support. I dig this one. You get in with the close above, stops in the right place, and it does everything it's supposed to do. And Victor, what an awesome job taking an in-the-moment lesson, doing the self-analysis, and then capitalizing on it not long after. Paul, the apology trade was a little different. I think it qualifies. The apology trade, Paul, was when, let's see if we can find one. When your 50-50 fails and it turns around and gives you the perfect trend trade short, and it's usually a momentum style entry after a 50-50 failure. That's what he used to call the apology with me. Excuse me. But I think anytime, there's always more trades, right? Excuse me. Sorry about that. And because there's always more trades, it seems, staying in the game just because one doesn't work, right? Hey, good morning, Cav. Modifaka, I'm getting over a little lung virus. And my wife had the same thing. It lingered for about a week after she felt fine. So I'm just there. I talk a lot, so I'm sucking a lot of wind, and it's just rattling around. Victor, love everything about this. It's viral there in Dubai too. All right, weak top, odds favorable, potential to break, all the momentum. That's your momentum trade from 70. Pete catches it on the way down, and when it pulls back, it just turns into that medium probability trade. So he holds his position and makes money. Nice trade, Pete. Nice trade. There's the trade. There's the exit. Taking profits when you lose momentum is important. I don't disagree. Hot air steam. Yeah, I'm the hot shower king. Appreciate it. And then Pete, with only the potential to break, that divergence keeps you from taking the next one. I like it there too. Not a shower. I don't have a steamer. All the momentum. Potential to break. Get in above trouble. Get out before things go bad. Nicely done. All right, Miss Trina. I'll give it a try, motherfucker. I will do that this afternoon. I'm at the try anything point. All right. Up, flat, weak. I'm trying to figure out what you did here, Trina. The triggers were still up. Was the retest entry correct? Am I making this up? I don't teach a retest entry. Trina, I don't know what that is. I think that's a picture you saw from John Novak yesterday, and you decided to try it today. Is that what it is? You saw John Novak's pivot stop out, decided to take it today? No? What do you say retest entry? What's a retest entry? Close above, right into trouble. Close above after retest of the area, and then entry directly into resistance. Trina, I don't... So that's your entry, right? And then that entry is directly into resistance. Is it still resistance when you enter? I feel like it is. And it's still resistance. And now it's support. And breaking away from support. And then it turns into a momentum trade. And then it continues up. So I don't know about a retest entry directly into an area. It closed above what? Resistance? And that turns resistance into support, is what you're telling me? So that's a prairie dog. And do prairie dogs work more than they don't typically? If prairie dog is in your arsenal, knock it out, have fun. I see an entry into an area that's still behaving as resistance. Right? And you had to know that it was resistance because you kept your stop huge. That's where it becomes support. That's where it pulls back to it. And that's where support holds. Which white bar? There's two right next to each other. No, it probably looked different live, Trina. It probably looked different in the moment. But that's one of the reasons why we use that concept, a full body of a bar that finishes, to change the roll of an area. Because what it does is it keeps you from taking the prairie dog. This one worked. And I don't know why you were break even. Everything was finally going right. So I don't think, I understand the mentality, and I understand what you're saying. And in the moment, it may have looked like it just pulled back to support and went. Okay, you were break even after the first target. That makes sense, right? That's 9 points. That's great. It's still a great trade. I just want to make sure you understand that this was still behaving as resistance, which probably had a lot to do with that spike down. But then when it finishes back up, it takes some of the panic out of it. But I think maybe what you're thinking, and this is where I just try to figure out. Let me see if I can find maybe something that looks like what I've got going on in my head. There's so much consolidation on these charts. Let me do this real quick. See if the S&P has one. I think I understand where you're going with. So let's do this. So there's your close above, right? And then it comes back and retests the area. Cool. So the biggest difference, Trina, is it's not trading directly into resistance. So if that were resistance right there, I don't know where it is. If that were resistance right there, if you got in on this bar, it's still trading into resistance even with the retest. Does that make sense? The same reason you may not take it here, it's still resistance. Because if you get in up here, it's very similar to that wick. And obviously there's not resistance there. I made that up. I hope that made sense. And these aren't really given prairie dogs right now. That's a good example. If you get in right here saying that it broke, you don't know if it broke yet, right? And it has the opportunity to potentially spike against you. I see what you're doing. I see what you're doing. Sometimes I can communicate. It just takes a little longer. Up, transition, pull back to the area, perfect close above. What a beautiful trade. Picture perfect, Trina. Is it easier when you don't trade directly into areas? Always. I think that's one of the things that you guys will begin to realize is that when you are in the correct trade, it doesn't give you time to panic, does it? The market knows it's the correct trade. The sellers know they got to the end of the road. The buyers know they've taken control, and the buyers just go, F you. Let's get to where we were going. And a lot of times, these perfect entries, they run fast. And when you're trading into trouble, that's when you start to see the sideways because they're at the decision-making point. Good job, Trina. That was such a good-looking trade. Triggers are down. Area becomes resistance. Small triggers rolled. Close below. Fits the rules 100%. And they took you right out. Took you right out. And Trina, it just didn't work. It's a great trade. You could defend that one. So here's the question that I'm going to ask. answer it, right? Answer it for yourselves. In a market that's been struggling to follow through, in a market that's been maybe producing more losers than winners, how many are you going to take before you hang it up, right? Or at least go to simulator and try to follow rules, and then it's not a big deal. If you're on simulator, have a blast, right? But you guys can recognize that the market's not necessarily trending. And you see it because look at all the zones, guys. That's what consolidation looks like. Your 1 minute chart will literally stack areas because there's so much indecision in the market. Yeah, Victor, awesome. Thank you for that. I put it up for discussion in the room, so we'll see what they say. All right, got a couple from Pete. What's up, Phil? Couple from Phil. All right. Pete, odds favorable momentum. Didn't quite make the termination. That's this bar right here. Little pullback to the area in the retracement room. Room to trouble. Nice trade. And that's the bar that he gets in on. Potential to break. Room to trouble. Pull back to the area and just threading the needle, Pete. Threading the needle. Market's going up. Didn't quite reach the termination condition. Tiny little snapback. He just jumps in. Makes a little money with momentum and path. Nicely done. Pete, WF making the ES do funny things. Think I'll take your profits and go skiing. Very nice. Got a buttload of snow yesterday. Why did I think you were in Florida? My kid wants to go skiing. He wants to go snowboarding. I got to make that happen. All right, 15-minute termination. Smalls below the large. Pull back to the HVA. Make money like you're getting paid to do it. And Phil, right on. Phil, taking 2 contracts. Dude, that's the perfect HVA trade. Nicely done. Nicely done. I know you've been studying that one. And then with triggers up, after you get paid on that one, you enter on the close above and make it the other direction. The short to the long, huh? Took the short to get to the long. Somebody ate their Wheaties this morning. Good job. That's good stuff. Who knows? Things may clear out. I don't know. I don't know what the time schedule. The HVA line, Phil? The HVA line. It depends on how you enter. So let me pull your chart up real quick. Technically, since you're buying or selling a top, it goes above the pivot high. Because that's where the buyers failed. That's a lot of risk to go counter trend, isn't it? Directly into a big chart area. This big chart area is a little problematic. So one of the things you can do, if you want, is very often when it pulls back to an HVA, I'll let it start back down to catch it. I mean, you caught it perfect. I'll let it head back down, and then I'll use that failure for a stop. I don't take a lot of traditional HVAs. I tend to take the aggressive one off the white bar and the open below the HVA and try to get the same idea out of it. I really just don't take a lot of counter trend. I don't take any on Ninja Trader, and I haven't been trading view lately. So like that right there, that would be my aggressive entry with a stop above to see if that really is a top. Because if they can get above the breakout bar after they open below, and the triggers are all wrong for this one, but that's a good visual of how I would pick my stop. Does that make sense? The triggers are all wrong. Didn't have a clear plan on the stop in the HVA Friday. Let it move against me until I blew the account so bad. No, I'm trading Ninja lately, Paul. I've been playing NASDAQ trend trades a little bit because John's programmers are coming up with the small chart stuff pretty soon. So I'm doing a lot of trading over there, just trying to I guess create a little bit of a Rolodex, things that I notice that can be programmed and put into play, whether it's multiple divergences, reversal bars directly into areas, stuff like that. So it's kind of an R&D, but because I believe in trend trade so incredibly well, it's also good trading, keeping you focused on the best of the best. All right. Do. And then Phil, another one of those things about HVA trades. How many times can you believe it's going to be the top, right? Sometimes you will have to take a trend trade twice, guys, but very often, if you're going counter trend, one and done tends to be a pretty solid plan. You'll have to come up with your own. If it's really going to be a top, Phil, they should never make their way back up there, right? Isn't that kind of the definition of a top? That was the bottom. It stayed the bottom. So, yeah. I know that when I started learning the HVA, when I started learning how to go counter trend a little bit, I abandoned everything rational. And I just couldn't wait to go counter trend. That was it. And oh my gosh, it was a absolute cluster foxtrot Charlie. 100%. And now they're broken out and running. Broken out and running. Guys, we're at a point where we can talk about whatever you want. Here's the account buster from Friday. Termination 98.50. I'm trying to see where you're at exactly on it. So it looks like you took the first one. So the purple box is your termination, right? That's the termination that you're using. All right. You ready for a language lesson? If I'm expecting this area to hold, shouldn't I be below it rather than inside of it? And I think that's that when you're inside of a zone, it creates indecision. And that's one of the things that I look for. When I look for those HVA trades is the clear path. And that means coming from below whatever number that was, which means I'm entering below. And it is a pullback to resistance, but it's against the triggers. It's not a horrible look. I'm trying to find things. So I'm on this constant quest for patterns. If I ever get hired here, you owe me $5,000, motherfucker? I don't think so. I'll tell you what, if you ever get hired here, you owe me 10 grand because it means it means I didn't talk them out of hiring you. So you can do it in cash. That works. Maybe clear path. I'm not sure, Phil. 06, 98. It makes sense. Man, look at that. Strong trending. Strong trending. I do. I love the way your name flows. It's just a cool name. Right on. All the more reason to trade smart, right? All the more reason to be consistent. All the more reason to follow rules. Should have started with your stop over that pivot high, then possibly move behind the HVA lines after the down bar, something along those lines. Woulda, coulda, shoulda, right, Phil? Woulda, coulda, shoulda. What we're realizing is that you just don't have a plan. But yeah, once it comes down and you get a down bar, it's the HVA's done its job. So if it breaks back above it, you don't have to give that much. And that's one of the beauties of the HVA trade is they're typically really low risk. I don't know what that means. And I do too, but it's lower risk, but it is counter trend, right? So how do you define risk? Is it a number or is it a probability associated with your trade? Victor pointed out earlier that he had to put a bigger stop on a trade where the market shouldn't go, but because it was the right trade, he had no hesitation. Victor, would you put stops that big on a trade that wasn't the right trade? Or that was really aggressive? And I think that's one of the things, guys. If you can't look at a trade and say, wow, that's really aggressive, I'm not going to take it. If you look at a trade and you say, wow, that's really aggressive, I'm taking it anyway, I hope that you're prepared to manage really assertively and reduce risk as quickly as possible, which is a good segue for this picture. What are you up against, right? And I guess for you, Phil, would be this one. So you're already fighting direction. If you don't have, if you're going counter trend, so high probabilities off the table instantly, right? So you have the entry area, you have the clear path. I'm just thinking out loud, guys. The market's not giving a whole lot, and we're just trying to come up with good lessons, right? What are things that we think about all day long that maybe translate into something smart? Um, and sometimes I'm just musing, Phil. How much am I willing to risk on an HVA trade? The answer is typically not much. Man, isn't that crazy? Do you guys want to see something? Just, and I'm gonna say it. It's 32 flavors of kick-ass. 3 divergences directly from a fib, and they screamed to Fibonacci resistance to the tick. Does anyone have any doubts that they knew exactly where they were going long before they got there? I like that, Trina. I don't ever want you to feel crappy. Go enjoy the afternoon. It's almost lunchtime. Go have something good. Pretty amazing, right? It's night there. What's the temperature like in Dubai at night? Does it get cold? You're going to have to change your last name to Novak. You keep asking me for money. One of the reasons why termination conditions are so important in the plan, it can stop a market. That was a 68 to 03. That was a 35-point run. And it just stopped dead right at a fib. Is that Celsius? That's Celsius though, right? You guys do metric? I don't know that much about Dubai. Sure, but 20 degrees Celsius. So that's almost 70 degrees here. Yeah. So that's pretty darn comfortable. That's shorts and a t-shirt weather over here. And now we got to see if they want that to be a top, right? Now we want to see if they want that to be the end of the road. Phil, how do you feel about breakout bars both directions? Right on an area. Above the termination. Whew, hard to go short with that look. Because if I'm expecting the one-to-ones to hold, I've made this mistake quite a few times. If I'm expecting the one-to-ones to hold, why would I enter above them? No, not at all. Then you got to work for it. My kids work. If my kids can't afford it on their own, they do without. Got that work ethic. Spoiled children become soft adults. We don't want that. Let's see what you got, Adam. Oh, thank you for this. Gap theory. Let's see if we can find some examples today. Excuse me. So I'm going to go through this. Adam, thank you for reminding me. Guys, we're going to talk gap theory for a minute. So we're going to do it in a couple ways. I'm going to start it with why it's important. Right on. I'm going to start with why the gap theory is important. The gap theory is what you will use. Dun, 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 dun. The gap theory is what you NinjaTrader users will use to define the midband as a termination condition. So when you look at the lineup, large chart midband if the large triggers are a full bar away. This is the gap theory. So the gap theory says if price pulls away from the synth triggers, that's the large triggers on your large chart, too fast and too far, into an area, then it will snap back to the triggers. It's not an absolute. It can be Fibonacci, it can be 1-to-1, it can be mid-bands. This is a really old picture, probably needs to be upgraded. So when it snaps back, what happens, and it hits something. So price reaches the mid-band. And we go right to where are my triggers. If your large triggers are below the reversal bar, what does that mean? That means that you can get an entire bar that prints before they come in contact with the reversal bar marker. That mid-band is the termination condition. So it's not the size of the bar that does it. It's the distance between where price is and those large triggers. If it is a full bar away, price is more likely to close the gap to those triggers. And that's really all it is. Price comes down, reaches Fibonacci, or reaches a mid-band. Large triggers are above the reversal bar marker. Price is more likely to close the gap, guys. That's the very basic gap theory. Price accelerates. Large triggers stay a full bar away. So here's an example without it ever even hitting the mid-band. When price accelerates fast, it closes the gap. I'm about to lose NinjaTrader. Excuse me. So what we're going to do is we're going to look at some examples and kind of what it means. So while NinjaTrader comes back up, I also took some pictures this morning, Adam, hoping that you would remind me. So I appreciate that you did. Struggling. All right. So this is a good example. And this kind of goes on the picture that Adam posted. So price hits Fibonacci resistance, and the large triggers are one tick away from being a full bar away. Guys, large triggers are moving averages. A tick up, a tick down, it's an average, right? That's super, super close. That look should perk up instantly. Why? Because it's more likely to close that gap. And what it does is it keeps you from just jumping in at this mid-band, and it keeps you from just jumping in at this fib, saying, man, it could close the gap all the way back down. So let's see if we got the S&P back up. That's all right. We went on without you. We went ahead and kept the lessons going. It can be. If you don't have a plan. All right, so we're going to let this come up, and then we're going to go back and look at it. So what does the gap theory mean? And we're going to find an example of it. Eventually. They're calculating right now. So here's what we can do real quick. Nexgen tracking sheet. Adam, do you have a copy of this? Under patterns, chart reading, there's a lot of gap theories in here. We can go through and look at these as well. Price reaches the mid-band. Large triggers are a full bar away. So the lesson that I want you guys to get out of this, most of you, your first instinct is go short. It's the gap theory. Guys, if you're going short, you're fighting direction. You're fighting momentum. You're definitely fighting the small chart. The gap theory is not an opportunity to go counter trend, not for the brand new user. What it is is when you've got a mid-band sitting inside of triggers right here in the middle of that gap. It's like a vacuum, and it literally sucks price. And virtually any trade you take between that mid-band where price was and those large triggers is more likely to get run over than it is to win. And then there's one of the ways where you can say it's more likely to happen is when the push back to them is from a bad top or a weak bottom. So let's go see if we can find a gap theory. Small triggers got through, price accelerates, closes the gap. Not looking for that 50-50 long right there, Adam, because of the weak bottom. And if you are looking for that 50-50 long, this weak bottom says you got a better shot letting it hit the synthetics. Let's find another gap theory. There hasn't been a lot because it's just been so sketchy today. There we go. Same thing. Weak bottom, hits the mid-band, closes the gap. So any trades you try before that gap is closed is more likely to get run over. If you were thinking of taking a 50-50 short before the gap is closed, it's more likely to get run over. Adam, does that make sense? Is that a little helpful, I hope? Trying to find some that aren't really nestled in fibs. You may be thinking long, but if you go before the synthetics, and let's see if we can bring this all together. And this was a lesson, gosh, we probably did this years ago in here. Oops. So if I'm thinking long trade, right? And you might be thinking long trade, not getting in at the one-to-ones, but rather waiting for the synthetics gives a fighting chance. Especially when they're split, waiting for the entry up in the synthetics or even the reversal bar from the synthetics, Adam. But you start to say, man, it usually gets to those synthetics. And when these are split, it can change your thought process on entry a little bit. I don't want to go with the mid-band above. If I'm really going to take a long trade, I'm going to let it close the gap. And then I'll see what happens. That's where the decisions are going to be made. So I think it really is. It's a solid thought process. And Adam, when we're looking at the small chart management, John sent me a video of it the other day. It is literally a reversal bar from inside of the synthetic triggers that's initiating trades. Because they're moving averages, more often than not, the synthetics do get hit more often than not. When the large and synthetic are overlapping, it's outstanding. But when they're not, those synthetics, see, even right there is a good example. Pulls up, hits the synthetics, drops back down. And now we've got the strong top. We've got odds favorable. We've got the potential to break. I'm keeping eyes, right? That's my one spot. And it's inside of those synthetics. Creates a little warm fuzzy for me. So it's not necessarily a go the other direction. It's a let's be patient and give ourselves the best chance of success. So termination, odds favorable, 3 triggers through. We've got one area where that market is most likely to bounce if we get a retracement. So we're literally just waiting. Oop, now my areas, nope, mid-band's right at the very top. As the market comes up, the mid-band comes down. If they give me a push, I've got odds favorable momentum. I've got room to trouble. I've got a mid-band inside of triggers. The only thing I need is a pullback for entry. Guys, this is your high probability trend trade. That's about as good as it's ever going to look. Pivot, stop out, add a fib, all the momentum, perfectly defined entry. The only thing we need is the fight. The first fight didn't get there. We're going to hope for the second fight. So let's just hang out and trade for a minute. All right, there's your reversal bar. Are they going to push up? I don't know. They might. Overlapping triggers is nice too. I agree 100%. All right, here we go. Come get us. Tick or two below the mid band. Stop will go above the large triggers. You guys ever wondered what your entry pattern looks like? This is it. If we get filled, we will manage it according to the KISS plan. There we go. Stop will go 1, 2, 3, 4, 5 ticks above the triggers. First target's at 100, second target's at 200. If I get a reversal bar, I'll move my new stop above that reversal bar. If my first target is hit, I will move my position to break even, my stop to break even. What's kind of cool, our great entry, our first target is our reversal bar if we get it. How cool is that? Momentum and path. Pull back to the area. And guys, with a little bit of experience, you might put that second target down at the next sign of trouble. We'll do that for fun. If we don't get stopped out, we need a reversal bar. If we get a reversal bar, if that first target is hit, we'll go break even. They're trying. The fight is on. So guys, this particular pattern typically wins 70 to 80% of the time, which means that it loses 20 to 30% of the time, which is why I have zero hesitation taking this trade in front of you. It fits the rules perfectly. I'm done. I don't have control anymore. The market's going to do what the market does. Still in the retracement zone, I refuse to panic. Rule number 3 is still in play. I refuse to panic. Still have odds favorable momentum. I refuse to panic. First target hit. We are now break even. Let's see how far they want to run. The KISS plan says get paid at 88.25. So if they hit 88.25, I want you guys to realize that was a $300 trade. There's your KISS plan target. We're going to create expectations. With all of this momentum, with nothing in the way, let's see if they go the distance. When that lower printed, the divergence, doesn't scare me at all, Sergio. That is one loss of momentum up against the best momentum ever. Remember, this is high probability. This is 4 triggers through. This is odds favorable momentum. The only exit condition I have for this trade, other than targets hit, is 3 divergences in the same price range. And unless that happens, I'm holding for the fib. You know what's cool is our break-even stop is outside of the retracement zone. What's changed? My small triggers are down. My large triggers are down. My synthetics are down. My momentum is awesome. My path is still clear. Guys, this trade just keeps getting better. You could have taken it off, taken your $300, waited for the next trade. We're going to see if this one wants to run. So we're going to play runner mode. The only way we'll exit now, because I don't want to give back $240, is if it closes above these small triggers. Actually, what? No. If it comes back up, we'll take another trend trade. Let's just let it run. Where the market is likely to go, where the market was likely to continue. And if we get there, where the market is likely to stop. Does everybody notice that support turned into resistance? We have gotten every freaking rule completely displayed. Guys, now I don't have a mid-band inside of triggers. I'll get out on the wrong side of those small triggers if there's a divergence because it may push up higher. If it doesn't happen, no big deal. But this is where I start incorporating management. If I get a pullback, I don't really have rules met for a trend trade. Why would I hold up beyond? So let's just let it run down. Come on, momentum. This is day trading, guys. One pattern. Prove it wins more than it loses. And then just let it work itself out. I feel like they're telling me we should have got paid at 200. There we go. Second divergence. Sell a pullback to the mid-band inside of triggers. Oh, it's going to go now without us. Sons of guns. Probably should have held that trade, but that's okay. I'm cool with $240. That adds up, doesn't it? Still have momentum, still have a clear path, still have an area inside of triggers, still know where the stop goes if we get a fill. Let's see what happens. Oh, you got a 15-minute VWAP? It's okay, I'm not trading the 15-minute. So we'll just see what happens. If it fits the rules, take the trade. If it wins, cool. If it loses, cool. Oops, I put that way too tight, but that's okay. Lost $100 on it. And now it's pulling all the way back up and my rules aren't met. Guys, that's day trading. That's 137.50. I'll take it. I like 137.50. And then Phil, that's good eyes on the VWAP. Good eyes on the VWAP. Instant reaction. All right, now the market's heading up. Here, you know what's more fun when you guys aren't talking? I'm going to load up the NASDAQ. Because it's 10 times faster. We can have more conversations. I'll tell you what, while that loads up, I'm going to take a minute. Guys, when I come back, if you have questions, please post them in the room. If you have pictures, please post them in the room. Phil, we'll start with yours. It'll give me something to talk about. I'll be back in just a couple minutes, y'all. Here we go. Here we go. All right, Phil, let's see what you got, man. Termination. Oh, I like that one so much better. White bar, breakout down. Opens below the HVA. Rockstar entry. That's 2 contracts. Can't lose. Good target. Did it make it? Four contracts. It did. Nice trade. Nexgen, 2 triggers through. Had weak bottom. 2 through. Same trade I took yesterday, not today. Good job, Nexgen. It's instantly alluring without divergence, isn't it? But that weak bottom. Oh, those weak bottoms. Do some squats. Good job pumping the brakes. Can be taught. All right, waiting on a trend trade. Didn't see any rules met. Did not miss a potential momentum trade, Papa. Sometimes it just doesn't give it to you. It hit that VWAP and launched, and it never gave you a clear shot for an entry. Yeah, happens sometimes. Happens sometimes. This is what I've got. I rebuilt this morning, Phil. Triggers up, room to trouble, pull back to an area, hit F5, see what happens. We've got 36 seconds before we know whether or not we get a close on the correct side of the triggers. 30 seconds. You guys see it? First it's up. There's room to trouble. Pulled back to an area. I just need a close on the correct side of the triggers that gives me enough room to hit that zone. That's probably not it. That's messed up, isn't it? There it is. Do we take it anyway? Is there room to trouble? Look at the risk, though. Oh, my goodness. Oh, my goodness. That's a lot of risk. You guys ever say to yourself, that's just too much? Why would I take that trade? Why would I take that entry? Is it the right entry? Of course it is. Is it up? It is. Is it room to trouble? It is. Is it a close on the correct side? It is. Is it worth $3,600 with them? Man, you better send me $1. Let's see. There you go, Phil. It happens, right, Jim? And then you just have to make the decision. Do I really want to take this trade? Do I want to wait for a better trade? We're taking this one just because it fits the rules. And this is an educational room. I know where my first sign of trouble is. Whoops. I'll take a percentage of my trade off if we reach said trouble. And because I'm not on the strong side of the triggers, if I take profits at 97.75, I'll probably go break even. Because that's not my strongest trigger look. But since entry, my small triggers have rolled up. My large triggers are rolling up. Everything still says up. That darn divergence high is being bouncy, isn't it? Oh, we got hit and not filled. There we go. Half off. Let's go break even and see if they go the rest of the way. You have to be happy with it if things hit the fan. Amen. This is where I would say, you know what? If they get back below this zone, I don't want it anyway. 1-to-1s are a great place to stop. That zone is a great place to stop. Could I just pull it down and just get paid and get the hell out of this trade? What do you guys think? Did it fit the rules? That's damn near the perfect trade, isn't it? Sure was a lot of risk. Do not go. It's a pretty easy $1,100. You're not out, Boaz? That big red line's enough for me. Was it, Papa? I had from 90 flat, I had almost 7.5 points. $140 per contract. It looked tight because of the way my chart was, but if I just do the math from the close to the first sign of trouble, it's plenty of room for me. Take that all day long. At $150 per contract, if I took all 6 off right at the first sign of trouble, it's an $850 trade. So, but we all have different things. It looked tight like that. Looks like it's got a lot of breathing room like this, doesn't it? Make sure your charts don't scare you. And there's the zone. Pretty good exit, I feel. Pretty solid exit. So we've got our one winner on TradingView. We've had our winner over here on NinjaTrader. Not a big one. Well, then we took the loser. So not so bad. We're at 66%. 2 different platforms. 1 set of rules. 3 rules on 2 charts. Was it? It was probably somewhere over here, maybe. No, we got it at 90. I'm not sure. See how the large sugars are way up here, Adam? It means I probably don't want that trade from the mid band. Let's see if they close the gap. Nope. They sure didn't. That was fun. I like it when we take winners together. Hey, Nathan, using only the trend trade on the ES, you've had weeks with negative P&L, sometimes up to 3 in a row around the holidays. This normal drawdown, or am I trading wrong? Well, Nathan, how on earth could I know if you don't show me your trades? So I'll find some picks and tell me why you took it. And we can fix whatever's broken. We can fix whatever is broken. No, Paul, it will not. Ninja will probably never be used on Pro Trader funding. He's doing small chart work for the automated system that uses NinjaTrader. AMP has a beef specifically the owner of AMP, has a beef with Ninja. So Nathan, during the holidays, sometimes it's a little more difficult, but without knowing if you actually have momentum or whether or not your path was in fact clear, or if your entries even make sense, it's really difficult for me to know. But I'd love to see what you're doing and see if there's a way for me to help. And say hi to your mama for me. I thought she was going to come hang out with us. Close above the ES, nowhere to go, huh, Jim? Just wasn't. Good luck, just no room. Some beef is tough, that's true. And that's okay. So, Jen, you said you just couldn't break your rules. You formed the perfect opinion, but you just couldn't break your rules. I'm proud of you right now. Good job. It's hard. It's hard to not break rules. It means you have to sit still. So, nicely done. All right. 29. So right here, Nathan. All right, so we already found your first challenge. Are you ready? You're about to be smarter. Do you see that divergence high? You don't have a clear path, Nathan. What you have is 2 triggers through, and you still have 2 triggers below on the most current area. And you also don't have a clear path on this fib because you don't have 4 triggers through. And you don't have a clear path yet on this fib because you don't have 4 triggers through. So that's okay. That's okay. And this is why I say, Nathan, and I say this with a little bit of arrogance, anything can be fixed if you show me what you're looking at. So I'm going to give you a cool picture right now. Every time price hits a line, I want you to count trigger lines. You only have a clear path if all 4 get through. So that's the first lesson. Does that make sense? So I want you to study this picture. Now it gets better. It gets better. Dun, dun, dun. So where did you enter? I don't see an actual entry. At the top of the arrow. Right there? Okay. Why did you enter all the way up there? So let's go to another rule. Okay. What's it confirming? So are you ready? Man, you are about to just have the whole game changed. I'm excited that you posted. Thank you. Thank you, thank you, thank you. I'm going to show you something really cool. There it is. There it is. Hold on. So here's the rules for entry. On the S&P, Nathan, you're not doing yourselves any favor waiting for confirmation on the perfect trade. This wasn't the perfect trade. But I want you to look at the rules right here. This is exactly the phrase I need you to memorize. I'm going to use a limit order to buy or sell a pullback in an area inside of triggers. So what we're doing is we're defining where trades come from. Trades originate at areas, at fibs, at mid bands, at yellow 1-to-1s. In those areas, have to be inside of this trigger range. So do you see how you never made it to the entry area? Which means you're not confirming a trade just because it went up. Inside of whether it is these large triggers here or the synthetic triggers here, it doesn't matter. Your trigger lines define where the retracement is most likely to go. So you never made it to the entry point. Does that make sense? Let me show you a picture. Hold on. You know I have a million pictures, right? An area, not even a fib, just say an area. Whether it's a fib, whether it's a midband, whether it's a yellow 1-to-1. It has to be inside of those trigger lines. So the tighter they are on each other, the more accurate your entry becomes. So far on this trade, and this is cool, because Nathan, I had a guy call me cussing at me once with the same idea. He wasn't posting in my room, and he swore he was taking great trades and losing. So, hold on. Bum, bum, bum. I'm so glad you did too. I promise you, there truly is nothing we can't rectify with a little bit of conversation. So your momentum was amazing, right? Everybody's good at momentum, strong triggers. But check it out. Nathan, you didn't have a clear path, did you? It was only the potential, not even great potential. And you never waited for the area inside of triggers. So my brain, and I'm taking over your brain for a second. My brain says, I'm kicking ass and taking names with the best trades ever. And I'm losing. Fudge. But we didn't say fudge. But what the reality is, Nathan, is you took a trade with only the potential to break, and really not very good potential with just 2 triggers. You're not entering at the best spot to take a trade. And now let's go one further. When you see momentum, or divergence, excuse me, you have to read that as a loss of momentum, which means, fudge, I don't even have 100% of the first advantage now. And that stupid pink line, Nathan, kills more trades that only have the potential to break than I care to mention. So if you were excited about the trade, I can see why. That's with all that momentum and the potential to break, wouldn't hesitate. This divergence right here is the giveaway that it's probably not going to work. Does that all make sense? Divergence on a 50-50 kills it more often than it doesn't. So I'm going to give you this. Maybe, hold on. Assuming I can find my toys. So this is the Ninja Trader KISS plan, Nathan. And this plan is designed to keep you focused on the absolute best of the best. So here's what I want you to do. I want you to not just have the checklist in front of you, but make sure you know what these mean. Make sure you know what it means to have strong triggers. I think you do. But the work that you need to do is on termination conditions. Did price reach an area? Where are my triggers? So that's your textbook termination. Now, if you couple that with the picture that I gave you, you'll know that it's nothing better than potential until 4 triggers go through. And that's got to change your whole idea on the trade. So on the KISS plan, the 50-50 trade says that you need 3 of the 4 trigger lines through. Now you have a fighting chance. It also says you need to come from a strong top or bottom. Momentum on both charts and no divergence on the 5-1 because it's such a deal breaker. I love that you posted, man, because now what you just realized, and nobody likes this realization, is that you've got a little bit of work to do. Now you've got to go back and study the very basic concepts of what it means to have a high probability trend trade. So I'm going to make it even easier for you. There's your checklist that I just dropped in the room. And that checklist, because, man, is the market coming from a strong top or bottom? You're going to use this concept to take the 50-50 trade. First, it's a termination. Then it's a strong top or bottom. Momentum, you're solid. There's your trigger count. And there's your pull back to an area inside of the triggers. And the verbiage is all there. And then there's the checklist. Do I have that spreadsheet? Yeah. I got everything for you, man. There you go. Boom. This is why we come to class and participate. And when you guys show me what you're doing, we can fix almost anything quickly. So Nathan, now your job, as you go through and go through this, post a few more trades as you take them. Really lean on those examples. Yeah. Thanks for showing up. John did a class once, and he led the class off by saying most of the time, people that don't find success with the software, I'm going to boot you out of here, matter of fact. Or I'm going to give you the microphone and let you get it all out of your system. A lot of times people create their own version of what it means to have the rules met. I did it a lot on termination conditions. And then eventually you get a little bit of feedback, and then we just really start cranking forward. So termination reverses the market. That's a strong bottom. Price reaches the area. Uh-oh. Potential to break as we talk about it, right? It's only 2 triggers. It's not the best look. The synthetics are way down here. The market could go there. So we're in a little bit of a holding pattern. It's good. It's getting better. Now we get that pullback. Buy at the area inside of triggers. Stop where the market shouldn't go. First target's hit, we'll go break even. Second target hit, we'll pull one down right at the fib because it makes sense. And there you go. No, you can't. There's your perfect trade, guys. How long did that take to make $800? But Nathan, do you see it all? Took a blink. So you got to learn these concepts so well that it happens that fast. Take a picture of that bad boy. That's where I go tell our client advisors, why are you not getting this in people's hands? Hang that one on the wall. I don't have to, Phil. They all look the same. They all look the same. That's what makes a great trader. Doing the same thing every time. All your father-in-law's deer heads look the same to you? Sad? Delicious? I don't know. What word are we going to use? They all look yummy. Nathan, I don't make recommendations. I refuse to. But. The Ninja Trader KISS plan, check it out, Nathan. Try to take all the stress out. The checklist is for entry. The perfect entry, the high probability entry, the best of the best entry. Now on the plan here, what I did do is I gave you a very basic management plan that uses 2 contracts, because it does a couple things for you. The first thing it does is it helps you understand stop placement and trust it, which is even more important. But it also gets you focused on getting paid, because a lot of times everyone's looking for a home run. The goal is to get money in the bank. So the KISS plan management is really dependent on you being able to learn the best entry. So if my entry is 2 ticks below resistance inside of triggers, this is 2 contracts. My initial stop will go 4 to 5 ticks beyond the triggers. That's where the market shouldn't go. That's where the advantage is gone. And that's one of the reasons why we wait for the areas. It typically reduces risk. And then targets are $100 and $200. If you don't get stopped out, it means you get a bar in the direction of your trade. I love this. You might use this for entry. I know you like confirmation. If it's the perfect trade, you're just wasting money on confirmation, right? But you can go 2 ticks above that, and then your only option is a tiny little loss or targets. And if it hits the first target, it's $100 in the bank. Children sing song about you. Life is great, right? And you're going to go break even. And you're going to say, with all the advantages in place, it's more likely to go to 200 than to 0. And if it goes to 200, dude, that's a $300 trade. That's a $300 trade in like typically 2 to 3 minutes. You're in, you're out. The advantages were there. The management was very mechanical, and you're learning concepts on how to move stops in the trade. And you're only focusing on simple stop movements, not targets. Does that make sense? That's a great way for people to come to terms with management. And then my magical phrase, you'll write your own management plan based on your experience reading the indicators. But the whole idea with everything that I do here is let me make it as bare bones for you. You don't have to think a whole lot other than the very basics. And then when you get good at that, branch out, blossom, be the flower that you are. Since the small triggers aren't past the red fib, which picture are we talking about? The one that I just showed? Well, you can't see the large chart, can you? This is just showing you entry and stops. You're overthinking it. You're overthinking it. You don't know what the large chart's doing. Large chart might be perfect. That might be a blue fib that I drew in because I love the color blue, especially at 71.25. This is about entry, and this is about stop placement. But you're right. If this were a medium probability trade, damn it, Nathan. Hey, look, there's management for the medium probability trade. Pretty cool, right? You know I think of everything. It's what I do. So now just, man, go simulate it. Do some market replay. Have some fun. Bring me some pictures. Let's talk about them for the rest of the week. And just make sure that you get that understanding back to where it needs to be. And I got no worries about you. You're welcome. I never claim to be smart, but I am good at patterns. Phil, the cheat code HVA entry still requires... Of course it does. Why would you fight strength counter trend, Phil? Ridiculous question. Yes, 100%. Yeah, I mean, it's a cheat code. It's your right to break that rule, right? It's always y'all's right to break rules if you want to break rules. That's up to you. But why is that? So, Phil, let's talk about it. What does this look right here tell me? That should scream, oh shit, don't go short. That's it. That's strong up. And that's up, right? I don't want to go short here. I don't want to fight everything. However, that's weakness. I've got a fighting chance. Small triggers are down. I've got a fighting chance on that pullback. So post a picture. Don't look at that. Holy crap. That sucks. Smalls are on the wrong side of the large. And look what happened. We got blown out of the water instantly. Still not rules met. Definitely not rules met. Show me a picture. Don't make me guess. Wow, missed another perfect one right there. Dang it, where were we? Thanks, Phil. Now my kids won't eat. Just kidding. It wasn't my money. I'm usually good at guessing sometimes. Don't have momentum. Therefore, I shouldn't even be looking at the clear path. Wrong side of the triggers. Let's see if they push lower, as they tend to do. They may go up. I usually am pretty good at guessing. You are not mistaken. Ooh, you guys woke up Ellie. You're in trouble now. Good class today, guys. Good lessons today. I'm digging it. You want to see something cool? The triggers have been up since 9:15. And look at where the market is. So you do have to ask yourself, if I want to go counter trend, how convicted am I? Not quite. Not quite, right, Phil? These brownies almost don't have any poop in them. When my wife is home from work and she hears me say stuff like that, she's like, did you really just tell your class that the brownies almost don't have poop in them? But it makes you think, right? We're so willing with our money to almost have it right. Sometimes you need to hear about the brownies. With our capital, with our investment. And then Phil, you want to see something really kick-ass? There's your pullback to the 1-to-1s. There's your white bar up. There's your open above. The triggers weren't right, but that's just a trend trade. And while we're so hell-bent on going counter, we forget to trade with the trend. Strong bottom, only 2 triggers, now 3 triggers, no divergence, but we have divergence. Missed it, you're in the kitchen. Well, I'm not willing to make kitchen jokes, but you're absolutely right, Jen. That was a beautiful trade. And it just wasn't your money. And you've been so patient. And it just wasn't your money. I hope you're making something delicious. Hope you make something delicious. Sorry, Paul. I missed one, didn't I? I apologize. All right, triggers up. Room to trouble. Pull back to the area. Close above. Good type management. Just didn't go, right? It tried, and you got to break even quick. Nice job, Paul. And here's one of those times where guys, where you gauge the reaction and you're really close to the termination, right? So Paul, you just came off a termination. Like just it's fresh in the brain. And that reaction from the termination created odds favorable momentum. That's a great reaction from a termination condition. Your entry is perfect. Your management is solid. When it couldn't just go, you said, F it, I'll wait for the next one. I like the way you handled that one. It's the perfect entry. And it's such a good read of all that momentum. And if it just doesn't go, you weren't going to lose money hoping that it did. I like it. Boaz. Oh, that's the one that I wasn't there for. Momentum, path, sniper entry, make some money, and out on the second one. Nice trade, Boaz. Sniper entry. Like a madman. All the momentum. I do, Paul. I've been burnt on that so many times. Because they're areas, right? If it misses my target by a tick, I just don't feel like I should lose at that point. I don't feel like I should accept a $400 loss when I was $5 away from where I thought the market would stop. Momentum and path. Oh, momentum's going away. I learned that one the hard way, Paul. I gave an awful lot of money back trying to figure that one out. Man, well, they broke out and kind of got some giddy up, didn't they? That's one of the fun things about going over to the NASDAQ with you guys. S&P is much more mellow. Perfect termination. Full reversal. Boaz, don't ask me that. Should I swim with sharks if they don't look hungry? I don't have a plan that incorporates the 15 minutes. Why would you have it if you're so willing to fight it? I think that would be the question. Why would you add a time frame that you're willing to ignore? So you have to figure out how you're going to use it. And you may find a way to use it, right? So Boaz, when I look at my trading view charts, but I'm trading Ninja, I like to be aware of where the areas are, but I trade my Ninja charts. If I'm thinking about going counter on a gap theory, I make sure the 15-minute are in the direction. So if I use that chart, I have to have rules for it. And I hate to admit this, Boaz, but I told my brother this morning, I don't know why I keep looking at those damn charts and trying to make decisions for one platform, because it hurts me more than it helps me. I will always lean on the chart that gets me into a trade. And it doesn't force me. I knowingly and willingly, like a Yahoo, go into bad decisions when I try to trade two different bar structures on 4 different time frames. I just don't have the bandwidth for it. I'm not that smart. Guys, don't tell anybody. So like if new people show up, tell them I'm smart. But all you older folks, you know the truth. You know the truth. I always ask people, if you're going to add an indicator, what does it add to your plan? So if I'm going to go to my indicators and I'm like, you know what? I really need buy-sell volume. How is buy-sell volume going to make me a better trader? I appreciate that, Boaz. How is buy-sell volume going to work its way into its plan? What rule is going to have buy-sell volume? And the reality is that if I can't come up with a rule to incorporate this into my plan, I'm better off without the distraction. Does that make sense? If I can't figure out how to use it, I'm better off not looking at it. A lot of people used to have that 21 time frame, and then they would fight it every chance they got. A lot of you guys have market flow, but you don't use it. You just look at it and let it talk you into stuff. Momentum and path, guys, we have it. Momentum and path. Those that are smart enough to handle that much data input belong in traders chat. They're good, really good. Yeah. Is the mid-band on the large chart a form of support and resistance? Triggers need to get through for a clear path. Nathan, I got you. You ready? You're going to walk out of here effing brilliant. I want you to know this. And here's the cool thing. We have instructions. What areas can behave as termination conditions? Well, you know these, support and resistance, right? Yellow 1-to-1s. You're familiar with the divergence lines, but I guarantee you ignore them a little bit because they don't seem as important as fibs. 3 divergences in the same area. That's a termination. Sergio asked earlier, Mark, why are you taking that trend trade with divergence? Because it takes 3 to be a termination. And then Nathan, when is the mid-band a termination condition? If the large triggers are a full bar away. So I want you to look at that spreadsheet that I gave you. And I want you to go to the blue section. So gap theory. The gap theory is what defines a mid-band as a termination condition. When there is a full bar back to the large triggers, the mid-band is in fact a termination. So depending on what the market is doing, we crashed Ninja. Depending on what the market is doing, the general rule of thumb is it's not a termination if the large triggers are not a full bar away. That is the very basic, Nathan. That is the vanilla, the black and white, the let it be an absolute. But let me show you a phenomenon. Phenomenon. Did anyone else hear that other than me? Almost there. Hold on. Darn crashes. So if you're coming from a bad top or bottom, Nathan, that first thing on your spreadsheet or on your checklist defining a strong top or bottom, if I'm coming from a weak top or a weak bottom, the mid-band area is more likely to hold. So if I get up to the mid-band here, because they're not coming from a termination, it's more likely to hold, create problems for me. That was the gap theory again, but this time off of 1-to-1s. And that's a little more advanced. There we go. So let's see if we can find a gap theory in here. May not. It's been pretty crazy for the last hour and a half, which is fun. Glad to have it back. Well, there's the gap theory. Mid-band. See how it pulls back to the triggers? That's your mid-band as a termination. You're not trying any short trades until that gap is closed. Mid-band, large triggers a full bar away. Not trying any short trades until that gap is closed. There we go. Those are a couple good examples. Mid-band, not trying that potential to break until that gap is closed. So it's very repeatable. Directly into a fib, I'm not going short halfway up. I'm going to let it close the gap to the large triggers. Does that make sense? So that recognition, oh my gosh, it is a bacon saver. So now we're coming into all these fibs. Well, now I have a clear path, so I'm cool. If I get a pullback, well, didn't. How quick does that happen? And now I don't have the momentum that I need. And that's, guys, if you're a NASDAQ trader, you have to be able to read it that fast. S&P, crude oil, you can go just a little bit slower there. So good day today, my friends. Good day today. Let's get you